In recent years, Vietnam's economic journey has been nothing short of remarkable. With rapid growth in GDP, increasing foreign investments, and a stable financial environment, the Vietnamese economy has captured global attention. This rise has led some to speculate, could the Vietnamese dong, VND, one day be included in the International Monetary Fund's IMF Elite Special Drawing Rights SDR currency basket? While this remains a significant hurdle, the idea is no longer viewed as far-fetched. To understand this possibility, we must first explain what the SDR is. Established by the IMF in 1969, the Special Drawing Rights is an international reserve asset created to supplement countries' official reserves. The SDR's value is determined by a basket of 5 leading currencies: the US dollar, the euro, the Chinese yuan, and the British pound. These currencies were chosen for their extensive use in global trade and their connection to robust, open financial markets. For Vietnam's currency to be considered, it must meet 2 essential IMF criteria. The currency must be widely used in international transactions and must be freely usable, meaning it can be easily traded and accepted for global payments. This is where the Vietnamese dong currently encounters limitations. Vietnam's transformation since the 2000s, particularly after adopting market reforms known as Đói Moi, has turned the country into a major manufacturing center. It is now a crucial hub for electronics, textiles, and furniture production, with large multinational corporations like Samsung, Intel, and Nike operating within its borders. Vietnam also plays a central role in key trade pacts, such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, ZPTPP, and the Regional Comprehensive Economic Partnership, RCEP. However, despite these economic achievements, the VND is not yet freely convertible. The State Bank of Vietnam, SBV, retains strong control over its exchange rate, setting daily reference rates and maintaining a tight trading band. Additionally, capital controls are in place to prevent rapid money flows in and out of the country. These measures are designed to protect the country's economic stability, but also limit the currency's usability on a global scale. To join the SDR basket, Vietnam would need to follow a path similar to China's before the yuan was included in 2016. This would involve gradually easing capital controls, increasing transparency, allowing greater exchange rate flexibility, and encouraging global trade to be conducted in VND. Vietnam would also need to support the issuance of VND-denominated bonds and expand the role of its currency in international settlements. However, reforms of this magnitude come with considerable risk, especially for a developing country. Policymakers must balance opening the economy with maintaining financial stability. Achieving SDR status isn't just a technical challenge, it's a long-term strategic decision requiring broad structural reforms and alignment with global financial practices, including clear data reporting and governance standards. Vietnam has taken meaningful steps forward, but still faces significant hurdles in areas like banking sector reform and state-owned enterprise management. Strengthening these systems would bolster global confidence in the VND and support its credibility as a reserve asset. Geopolitics also play a role. SDR inclusion isn't purely economic. Political considerations matter. China's yuan gained SDR entry in part due to its growing influence in international institutions. Vietnam, while increasingly important, will need to build deeper alliances within the IMF and prove its global economic significance. That said, Vietnam has favorable tailwinds. As supply chains shift away from China, Vietnam is emerging as a major alternative. Its strong trade ties with the United States, European Union, and neighboring Asian countries are expanding. The country also gained recognition for its effective response to global economic shocks, including the COVID-19 pandemic. If these positive trends continue, Vietnam's influence in global trade could increase significantly, possibly raising the VND's international profile. Some financial experts argue that the current SDR basket underrepresents emerging markets, suggesting it might need reform. If the IMF ever broadens the criteria or structure of the SDR to better reflect a multipolar economic world, currencies like the VND could benefit. However, realistic timelines must be acknowledged. The VND is still years, possibly decades away from meeting the full set of SDR requirements, but the fact that this discussion is even happening demonstrates Vietnam's tremendous progress. Just a decade ago, such a prospect seemed unrealistic. Today, it's part of a legitimate conversation. In summary, while Vietnam's inclusion in the SDR basket is not imminent, it's not out of the question. Reaching this milestone would demand deep reforms, increased currency flexibility, and greater integration into global financial systems. Vietnam has already proven that transformative change is possible with strategic planning and policy discipline. Whether or not the VND eventually joins the SDR basket, one thing is certain: Vietnam is rising, and the world is beginning to recognize its growing economic influence. Stay with Iraqi Dinar News Updates for more coverage on global financial developments and how they relate to emerging market currencies like the VND.